I have £50,000 to invest. What should I do with it? Some people spend years with 50k sat in their bank account because they can't find the right answer to that question. And I was the same. It took me months to make a decision on making my first deal happen because there were so many different options available. And I was worried that I picked the wrong one and just lose all of my money. But now I've been involved with over £30 million worth of property transactions. I can tell you it's a lot easier than you think. So in this video, I'll explain the 4 steps that I would take to invest £50,000 in property if I was starting out again, and how to turn your £50,000 into a 10 property portfolio in just 5 years. And before we talk about investment strategies, the first step is the most fundamental thing that you actually need to understand. Otherwise, you're just going to lose money with whatever you do. Because I meet so many people who have a pile of cash sitting in their current account for years because they're terrified to take action and buy. And I get it. It can be scary, but the alternative is actually a little bit scarier. Take a look at this graph, right, of the UK housing market over the past few years. If you zoom out over a long enough period of time, the trend is pretty obvious. It has skyrocketed up. So what does this mean? Well, let's say that somebody inherited £50,000 in the year 2000 and they were looking to buy a property, a nice 2-bed property around the corner from them for the average UK price of £80,000. However, they were worried about the market crashing and they were busy with work and they couldn't find the perfect deal. So instead, they just put their £50,000 in a current account and decided to wait. And eventually in 2010, they felt ready to start looking for a property again. But that exact same house was now on the market 10 years later for £180,000. In other words, their £50,000 had remained exactly the same, but in the meantime, inflation had eaten away at their money and everything else had increased in value around them. As an investor, this is the most important thing that you can understand before you actually start. Don't try to be clever and time the market. It's better to just get your money into the market and get it moving sooner. So with that in mind, if £50,000 landed in my bank account tomorrow, what would I do? Well, I'm going to run you through the most passive investment scenario possible. The first thing I'd do is I'd pull out my laptop and rather than scrolling through property websites or trying to call up estate agents and get a good deal, I'd run this very quick calculation. With £50,000, you might think to yourself, I could just go and buy something for £500,000. You just take out a 10% deposit and there you go. That's all good, right? Well, when you're investing in properties, you typically want to rent them out. So it's not actually that simple. You can't just put down a 5 to 10% deposit like you can with a personal home. There's much stricter rules around deposits and requirements from lenders when you're buying buy-to-let properties, which means that you can't borrow as much as you might think against the value of that property. So with £50,000, realistically, you're wanting to be buying something somewhere in the region of £150,000. So between the deposit, the legal fees, stamp duty, and a few other costs, your total purchasing fees will be around £44,000. And you can even keep that £6,000 spare in your bank account for a rainy day. Now, this might feel a little bit restrictive, but being conservative with the budget is actually really, really helpful in the long run. You don't want to completely stretch yourself early on, and it helps you narrow down your focus. And it'll actually enable you to jump on the property ladder faster, which is what we actually want. So now that you've got that number in mind, it's time to get a little bit more tactical, because now we want to find an area, a location where there is decent capital growth. Otherwise, you'll be struggling to just keep up with inflation anyway. So how do we actually go about finding this area? How do we do this? If you go onto Rightmove and go to their Inspire section and go to Housing Trends, because apparently housing trends are inspirational. If you then go to the tab Regional Trends, it'll pull up all the different regions across the UK and tell you what their average property prices were, what their monthly change was, what the year-on-year change was, and the average days that it takes to sell. This is just a really high level approach. But what we're doing in this is if your budget is around £150,000, what I've found works is if the average purchase price in the region is less than £300,000, then you'll be okay. So as you can see, if we scroll down, you're probably not going to be wanting to buy in the southwest, the southeast, in London, in the east of England. But what you could do is look at Wales, West Midlands, North West, all of these other places. So if you were to look in those regions, you're much more likely to be able to find something for £150,000. Then what we want to do is niche down the area a bit more specifically. So maybe you want to choose a region that's close to you, or a region where you like or you know it very well. What we would do is we would jump onto Google Maps and we would choose a location within that region. So for me, if I was going to invest in the Northwest, I might be looking at Bolton, Manchester, Warrington, Liverpool, Blackpool, Preston, Lancaster, Morecambe. I want to be looking in these areas, around the areas that I want to be looking at in that region. Okay, so let's say, for example, I wanted to go into Liverpool. Okay, Liverpool is the area that I'm going to choose. What I then need to do is I need to go back to Rightmove and go to house prices, sold house prices, and search for Liverpool. Now, what you want to do is have a quick look at what this bottom line says, because this is a very quick summary that Rightmove give you based on what has happened to property prices over the last few years. So the overall historical sold price in Liverpool over the last year was 1% down on the previous year and 3% up on 2021. Okay, so it's dropped in the last year on average, but it was up the previous year. So we're net positive at the moment. We want to niche down a little bit more than this, because this is obviously incredibly broad, and there'll be lots of areas within Liverpool that have done incredibly well. There will also be areas in Liverpool that have done particularly bad. So we want to niche it down. So I'm going to go for, as an example, if I was to search L4 as the postcode, we can see something a little bit more interesting here. The historical price in L4 in the last year was 1% down. Okay, not ideal, but it was 10% up on 2021. So what that means is we're currently net positive 9% over the last 2 to 3 years, which is actually a pretty good return. Now that was an example, but you want to figure out where this property is available for £150,000 and then do your research in those locations. So what kind of things could you be looking out for? Well, if you check on the house prices like I just showed you, and if things are looking positive over the last 2, 3, 4, 5 years, then we're looking really good. Now, for me, I like to think on average, you want to be looking at about 3 to 5% on average year on year. So some years it might be down, some years it might be up, but on average, you're looking at an increase of 3 to 5%. If that's the case, you're golden. If not, I'd just steer clear of it. Now, if you want this information faster, you can get access to the property investment playbook that I've created, which as part of that, you can see all the hotspot areas that I personally think are really, really good to invest in the UK, as well as a bunch of other stuff that you can get access to completely for free. Links in the description. Okay, so once you've bought somewhere for £150,000, what's next? How can we turn that initial investment into something life-changing? Well, from this point, you have a few options based on your expertise, but let's stick with the passive option. And let's say you do something really basic. So let's say you do a really basic renovation and you rent the place out for £900 per month. Well, that's great, but after all the maintenance and the tax, you probably won't be raking in all that much profit. So how can you scale this thing and make more money? Well, this is why the actual research phase is so important, because let's say you invested in a low growth area where the property value didn't increase over the last 2 years. That means that in 2 years' time, that £150,000 property is worth £150,000 still. Whereas if you pick an area with high growth and you're able to get a little bit of a discount on a £165,000 house, you bought it for 150k, then in the next 2 years, if there was decent capital growth, your property could be worth £180,000+, which is a nice £30,000 increase on the value that you actually purchased it at. So at this point, I'd refinance the place and pull out about £30,000 plus. And with that, plus the rental income that you've made and the savings that you've put aside from your rental income, I now have a deposit that could go on to the next house. Then it's just a matter of rinse and repeat in this process. And you can do this over and over again until you scale your portfolio to the point where you've got enough rental income to actually retire. And realistically, if you play your cards right and do your research properly, you could own a portfolio of 10 houses in 5 years just by doing that. So your initial £50,000 could very feasibly turn into 10 houses in 5 years with the right compounding of capital growth. But the key here is that you make sure you pick the right deals. If your figures are off and the deals are dud, you could find yourself in a really crap situation. So how can you be sure that you're getting a really good deal? Well, watch this video next where I can show you what steps you need to consider.